This video reveals how the SpaceX IPO is reshaping global market liquidity. It is essential for understanding current investor sentiment. SpaceX has finally landed on the public market with a historic listing. The initial valuation of the company was $75 billion. Bloomberg Markets reports that demand reached $350 billion. This massive interest is nearly 5 times the actual offering size. This frenzy has officially made Elon Musk the world's first trillionaire. Nobuhiro Tomatsu is the CEO of a global investment advisory. He specializes in market speed and analyzed the first-day performance. He noted a sharp 19% surge in the price after trading began. Tomatsu identified specific mechanisms designed to boost the stock price. These tools were used to ensure a strong start for the aerospace giant. He believes the listing was carefully engineered for success. This creates a powerful but complex entry point for new investors. However, some analysts warn that the valuation might be unsustainable. Nobujuku is a Japanese market analyst with 500,000 followers. He specializes in macro cycles and cautions against a valuation trap. He warns of a potential drop in SpaceX shares months after the IPO. The sheer scale of this listing is drawing liquidity from other sectors. High-growth tech stocks are feeling pressure as capital rotates. Investors must balance this extreme hype against looming macro risks. We will explore how this shift affects your global portfolio today. Geopolitical tensions in the Middle East are shifting global market focus. Crude oil prices recently hit 3-month lows despite ongoing skirmishes. The Financial Times notes this drop is driven by hopes for a peace deal. However, market participants remain on high alert for sudden shifts. Yenzo Market is an FX and macro specialist focused on institutional flows. He describes the current situation as a fragile and uncertain truce. He highlights Donald Trump's recent calls for Israel to halt its strikes. Yenzo suggests this political landscape could serve as a buy signal. This is because any failure in diplomacy would cause a rapid price rebound. In contrast, a far more aggressive risk factor is developing in Iran. Shekinah News reports on Iran's bold move regarding the Hormuz Strait. The outlet warns that Iran may attempt to stop all free passage. Such a blockade would threaten nearly 20% of global oil supply. This vital artery is essential for the stability of energy markets. Iran's willingness to disrupt trade flows creates a dangerous floor. For Japan, which imports most of its energy, this is a top priority risk. Investors must balance these peace rumors against the threat of blockade. Expect extreme volatility as capital rotates away from the SpaceX IPO. Global liquidity is moving between tech growth and geopolitical safety. The next few weeks will decide the direction of the energy sector. Keep a close eye on institutional order flows near the Hormuz headlines. U.S. inflation data came in unexpectedly hot this week. Strong employment figures have triggered a sharp market decline. House of L, a macroeconomic commentator on inflation, warns of core CPI. He notes that the resilient labor market makes the Fed's job harder. This implies that interest rates will stay higher for much longer. Investors are now re-evaluating the timing of potential rate cuts. This pressure is visible in the bond market as well. Wall Street Truth Bombs, a channel focused on banking risks, noted a milestone. The 30-year U.S. Treasury yield crossed the significant 5% threshold. This surge signals the official end of the low-interest era. Global liquidity is tightening further after the SpaceX IPO we discussed. Capital is rotating out of growth stocks into higher-yielding debt. Across the Atlantic, the European Central Bank delivered a major shock. The Financial Times reports the ECB's first rate hike since late 2023. This aggressive move stems from the energy shock linked to the Iran conflict. Central banks are responding to the volatile oil flows we saw earlier. High energy prices are driving inflation back above target levels. As risks rise, central banks are forced to stay extremely hawkish. High interest rates are no longer a temporary hurdle for investors. They have become a structural reality for all global portfolios. Tech valuations will face intense scrutiny as capital costs climb. We must monitor how these yield levels redefine market stability. The global shift in liquidity is reaching a historic turning point in Japan. A psychological shift has occurred in the heart of the Tokyo market. For decades, Toyota Motor has been the undisputed king of Japanese industry. However, the AI mania has finally triggered a regime change. Kioxia has temporarily become Japan's most valuable firm. It surpassed Toyota in total market capitalization. Nikkei CNBC is a leading business news channel for professional traders. They report that this event marks a symbolic and structural new era. The Japan Times is the oldest English-language daily newspaper in Japan. They attribute the surge to a staggering valuation of 44 trillion yen. This explosive growth is purely driven by demand for AI-specific memory. The world is no longer just looking for traditional hardware or automobiles. Instead, focus has shifted to the silicon powering the AI revolution. Zeikai Shimbun is a financial newspaper focused on corporate disclosures. They highlight that supply chain risks are pushing valuations higher. Memory shortages are driving up the price of Kioxia's high-end products. This creates a unique environment for the semiconductor giant. Investors must consider the historical context of this flip. Toyota has long represented the stable, manufacturing-based economy. Kioxia represents the volatile but high-growth future of technology. This cap flip mirrors the SpaceX frenzy we discussed in the first section. Both events show capital rotating into companies that define the next decade. However, this shift also brings new risks for individual portfolios. Earlier, we saw how high interest rates are tightening global liquidity. The cost of capital is rising across the Atlantic and in Japan. Semiconductor stocks are sensitive to these rising interest rates. If the AI hype cools, these massive valuations could face a correction. Personal investors should monitor memory spot prices and supply constraints. The next few months will test if Kioxia can maintain this premium. Will Japan remain a chip-first market? Or will the old industrial guard reclaim its throne? This battle for market cap defines the new Japanese investment landscape. Keep a close eye on sector flows between auto and tech. The AI-driven structural change is now a reality for every global investor. Understand that your portfolio must adapt to this silicon-centric world. The Bank of Japan is facing its most critical test in decades. The pressure on Governor Kazuo Ueda is reaching a breaking point. Earlier, we discussed how high global interest rates are tightening. Now, a new domestic risk has emerged within Japan. The Financial Times reports that Governor Ueda has been hospitalized. This creates a leadership vacuum at a very sensitive time. A crucial vote on interest rate hikes is approaching. Market expectations for a policy shift are surging. The Japan Times notes that a hike to 1% is now the base case. Former officials suggest this move is necessary to defend the yen. This would be a historic shift for Japan's monetary policy. However, the governor's health adds a layer of extreme uncertainty. Investors are worried about the lack of a clear backup plan. The foreign exchange market is reacting with high volatility. Yenzo Market is a specialist focused on institutional order flows. He identifies the 160 yen level as a critical psychological barrier. He warns that the US dollar to Japanese yen pair is sensitive to central bank moves. If the hike is delayed, the yen could collapse further. This would fuel the energy inflation we discussed regarding Iran. For individual investors, this shift creates winners and losers. Rising rates generally benefit the Japanese banking sector. Higher interest margins could boost stocks like Mitsubishi UFJ. However, we saw the Kioxia Cap Flip earlier in the AI mania section. High-growth tech stocks are sensitive to rising borrowing costs. A sudden move to 1% could trigger a sector correction. Next week will be a major turning point for the Tokyo market. Watch for official updates on Governor Ueda's condition. Any sign of delay will likely trigger massive yen selling. Conversely, a hawkish surprise would hit the bond market hard. Global liquidity is already fragile after the SpaceX frenzy. The BOJ's next move will decide the yen's fate for the year. Investors must prepare for a regime of higher interest rates in Japan. Masayoshi Son is pivoting SoftBank entirely toward the AI revolution. OpenAI has reportedly filed for a confidential IPO. This move should be a major victory for Son's aggressive strategy. However, a significant obstacle has emerged for the conglomerate. The Japan Times, the country's oldest English daily, reports a stalled deal. Specifically, negotiations for a $6 billion loan have hit a wall. This margin loan was intended to fund OpenAI's rapid expansion plans. The stall highlights the friction in the current high-interest market. CNBC analyzes Son's unique buyout playbook for AI startups. This strategy demands immense capital to secure dominant market shares. Nikkei CNBC notes SoftBank's struggle to find momentum despite the IPO. They are a leading business news channel for professional traders. Looking at the charts, SoftBank's stock has risen over 68% recently. However, a technical dead cross between the 5 and 25-day averages appeared. This signal occurred on June 12, indicating a potential short-term peak. The RSI currently sits at 48.2, showing a neutral market sentiment. This cooling reflects the broader liquidity drain from the SpaceX IPO. Earlier, we saw how high global rates are tightening market conditions. As central banks hike rates, the cost of aggressive leverage is rising. Son's AI vision is now colliding with a more disciplined financial era. Investors should monitor if the OpenAI filing can restore market confidence. Next week presents a minefield of macro events for global investors. The SpaceX IPO hangover is draining liquidity from traditional sectors. Meanwhile, the Bank of Japan faces a leadership vacuum and a potential rate hike. Zeikiai Shimbun predicts the Nikkei will trade between 64,000 and 68,000. This reflects the extreme volatility expected from the upcoming FOMC. Masaki Kamioka is an MBA holder and author of 31 business books. He emphasizes holding a large cash position of 12% right now. This buffer is essential before the market enters next week's turbulence. However, some remain optimistic about the structural shift in Japan. Kei Asakura is a veteran economist with a massive investor following. He believes the Nikkei is entering a sustained long-term uptrend. Short-term geopolitical shocks are seen as strategic entry points. Investors must balance long-term growth against immediate liquidity risks. As we saw with Kioxia, AI remains the dominant engine of this market. Monitor the 160 yen level and 30-year U.S. Treasury yields closely. Your portfolio must remain agile as these historic shifts unfold together.